All right, let's look at Beyond Meat, ticker BYND. The U.S. markets are closed for Friday, November 14, 2025. The stock settled at $1.08, which was a significant jump for the day, up 6.93%. It then ticked up slightly more in after-hours trading, moving to $1.09. Now, seeing a nearly 7% gain might make some investors perk up, thinking this is the start of a turnaround. But let's be absolutely clear. When a stock is trading at $1.08, a 7-cent move looks huge on a percentage basis. This isn't fundamental strength. This is the kind of volatility you see when a company is fighting for its life. The expectation, the hope, is that this gain means something positive, that the bottom is finally in. The reality is that this is likely just statistical noise in a much larger and much more concerning story of corporate decline. This 7% pop is almost certainly a reaction to the stock being profoundly oversold after its latest financial disclosures, which were, to put it mildly, a confirmation of the market's worst fears. For years, the narrative surrounding Beyond Meat was clear. This was the future. This company was going to disrupt a multi-trillion-dollar global industry. Investors, especially those using accessible platforms like the Robinhood app or SoFi Invest, piled in believing they were getting in on the ground floor of the next Tesla stock, something that would redefine its category. The expectation was that plant-based eating would move from a niche market to the global standard, and BYND would be the primary beneficiary, much like Apple stock dominates the premium smartphone space. The reality, as this $1.08 price tag shows, has been a brutal lesson in consumer behavior, competition, and cash burn. The story that so many bought into has completely diverged from the financial facts. Let's really pull apart this recent stock movement. The company just reported its third quarter 2025 results, and they were disastrous. Net revenues came in at $70.2 million, a decrease of 13.3% year over year. Think about that. In a category that was supposed to be in high growth mode, the leader is seeing sales shrink. The volume of products sold dropped 10.3%. People are buying less of it, period. But it gets worse. The company's net loss was $110.7 million. That's not a typo. They lost $110.7 million on $70.2 million in sales. This was massively wider than the $26.6 million loss in the same period last year, largely due to a $77 million non-cash impairment charge. That impairment is basically the company admitting that its long-lived assets, its factories and equipment are not worth what they thought they were. It's an accounting-based admission of failure. This brings us to the core problem: cash. Beyond Meat is burning through its reserves at an alarming pace. The company reported a cash burn of $42 million in the third quarter. This creates a feedback loop of destruction. The low stock price makes it incredibly difficult to raise new capital through equity offerings without massively diluting the few remaining shareholders. Taking on new debt is equally problematic because their balance sheet is weak, meaning any new debt would come with crippling interest rates. This is the reality that institutional investors, the ones using sophisticated platforms like interactive brokers trading, are trading on. They see a company that is in a race against time. The 7% gain we just saw, that's almost certainly short covering. Traders who bet against the stock, shorted it, are taking profits after the awful earnings report, and that buy-to-cover action artificially pushes the price up. It's not new money coming in with a long-term belief, it's old bets being closed. And the competition? This is a key area where the initial expectation fell apart. The belief was that BYND had a first-mover advantage that would create a deep moat, similar to how NVIDIA stock built a moat in high-performance GPUs. The reality is that the barriers to entry were far lower than anyone anticipated. You now have Impossible Foods, which many consumers say has a superior product. But more importantly, you have every major grocery chain, Kroger, Safeway, Walmart, developing their own private label version. And you have the traditional meat giants, the Tysons and the JBSs, who have the scale, the distribution, and the capital to compete aggressively on price. Beyond Meat is trapped. It can't compete on price with the private labels, and it's losing the brand loyalty war because the category itself is shrinking. The products are stuck in a specialty aisle in the minds of many consumers, not viewed as a staple. Consumers are also trading down due to inflation. When budgets are tight, a premium-priced plant-based patty loses out to traditional, cheaper proteins like chicken, eggs, and ground beef. Recent market research shows that U.S. demand for animal meat is at multi-decade highs, a complete reversal of the trend BYND was built on. This is a stock where you see a lot of chatter on Robinhood stock trading forums. People see the $1.08 price and think, it was once $230. If it just goes back to $10, I've made 10x my money. This is a classic psychological trap for those doing self-investing. The $230 price is irrelevant. It's gone. The company that existed at $230 is not the company that exists today. Today's company is a $1.08 company fighting for its life. Any online investment strategy needs to be based on today's facts, not yesterday's highs. Even automated long-term products like Schwab Intelligent Portfolios or a SoFi Robo-Advisor would never include a stock this speculative in a diversified long-term plan. This is not an investment. It's a speculation. It's a gamble that management can pull off a one-in-a-million turnaround or that the company gets bought for its remaining brand scraps. Though who would buy them in their debt is a serious question. So, what does Beyond Meat actually do for those who missed the initial hype? This company was founded on the idea of creating plant-based meat substitutes, burgers, sausages, chicken, primarily from pea protein. The goal was to replicate the taste, texture, and experience of eating traditional meat, targeting not just vegans but mainstream flexitarians. They had massive early success. Their IPO was one of the most successful of its year. They inked major deals with restaurant chains. This is where the expectation was built. The reality? Many of those partnerships were trials that were quietly scaled back or discontinued. The Beyond Burger didn't become a permanent high-volume item at major chains. Why? Reports indicate low consumer uptake. The products just weren't flying out of the restaurants. This past success is now an anchor. It shows a peak they have fallen from, and it's a reminder that consumer adoption, not just press announcements, is what matters. Let's look at the institutional activity. It's a sea of red. Hedge funds that were once long have either closed their positions or flipped short. The only support is coming from index funds that are forced to hold it because it's part of a small cap or food tech index. But even that is tenuous as its market cap collapses. This is the kind of scenario that advanced traders on interactive brokers trading platforms live for, the volatility, the shorting opportunities. But for the average person looking for online investing options, this is a danger zone. It's not like buying into broad Fidelity mutual funds or Fidelity ETFs, which are built on diversification. This is the exact opposite. This is high concentration, high-risk speculation in an individual broker account. When you open your Fidelity account or check the Fidelity mobile app, you're looking for assets that grow. This asset is in survival mode. Let's dig even deeper into the financials because this is critical. The company has a significant debt burden. They have convertible notes that are coming due in the next few years. When those notes were issued, the stock was high, and the expectation was that they would convert to equity. Now, with the stock at $1.08, that conversion is impossible. That means these notes will mature, and the company will have to pay the principal back in cash. Where will that cash come from? This is a ticking bomb on the balance sheet. Management recently announced a debt exchange, which helps them kick the can down the road, but it's a restructuring, not a solution. It's a move a distressed company makes. Analyst firms like Mizuho have recently slashed their price target to $1, maintaining an underperform rating. That's not a suggestion to sell, it's a prediction of total failure. Where does this go from here? Let's map out the scenarios. The bearish case is, unfortunately, the most straightforward. The company continues to burn cash, demand continues to fall, and within the next 12 to 24 months, it's facing a severe cash crisis, forcing it into bankruptcy or a fire sale acquisition for pennies on the dollar. The stock goes to zero. This is the primary risk and, frankly, the most probable path given the current data. What is the bull case? It's a long shot. First, they would need a complete restructuring and survive their cash crunch. Second, they would need a legitimate breakthrough in their product, a Beyond Burger 3.0 that is somehow dramatically cheaper to produce and significantly better tasting, convincing consumers to come back. There is no clear catalyst for any of this. The story is obviously divisive. The company still has its believers and it has a legion of skeptics. So let me know what you think in the comments. Is Beyond Meat completely finished, or do you believe this is a turnaround story in the making? Comment "finished" or "turnaround" below. To wrap this up, that 7% jump we saw on Friday is not a sign of life. It's a symptom of the volatility that has consumed Beyond.